Welcome back. Our next presenter for today is Rodney Manor and Nathan Lawton. Rodney and Nathan will present on Enron, greed, manipulation, and auditing failures unpacked. Rodney and Nathan's mentor is Dr. Vicky Eidson. Rodney and Nathan, I will turn it over to you.
Hi, I'm Nathan Lawton, and this is Rodney Manor, and we are going over the fraud case of the company Enron. So to give a little overview of the company, Enron is a natural gas pipeline company founded in 1985, and they are located in Houston, Texas, and kind of covered the southwest region of the United States. So it is important to note that they were a public company, so they were traded with different shareholders from really around the world. And throughout their life, they ended up trading in energy derivatives, or just in a simpler term, they traded in power during the California energy crisis. And a lot of their shady practices and unethical practices led to them declaring bankruptcy in December of 2001. And if you wanted to just learn more about the case of Enron, there is a movie called Enron, The Smartest Guys in the Room. So some of the key players in the fraud, the first is Kenneth Lay. He is the founder and CEO of Enron. He was the CEO for the entirety of the company except for about 7 or 8 months in 2001 when Jeffrey Skilling was when he was the CEO. And before that, he was the president and COO of the company. The last of the major management key players is Andrew Fastow. He was the CFO from 1999 to 2001. And the auditing firm was Arthur Andersen. They audited Enron for the entirety of Enron's life. Dynegy is an energy company that Enron attempted to sell itself to before it eventually declared bankruptcy. Bethany McLean is an American journalist that put out an article about Enron and some of its practices. Blockbuster, Enron and Blockbuster attempted to make a streaming service, and Enron eventually canceled that agreement with them. And Sharon Watkins is a whistleblower from inside the company that talked about a lot of their shady practices. So a little bit about their life. They kind of had a very common growth from 1985 to 1999, which on the chart here is the period from the start all the way up until that second dark line there. And in 1992 is when they introduced mark-to-market accounting, which was a contribution by Jeffrey Skilling. A part of his hiring, he required that the company switch over to the mark-to-market accounting. And what that is basically a company will, any assets that they have or anything that they own, instead of recording it at the cost that they bought it at, they will record it at the cost of its market value or what it's worth. So anytime they would have some sort of contract or anything, for example, their contract with Blockbuster, they created this streaming service, and right after they signed the contract, they boosted its value to what they thought the gains they could make on it were. And where the fraud comes in is when anytime they didn't meet those gains and had a loss, they would not record those losses, and they would transfer over those assets to what is called an SPE, or a special purpose entity, so that they did not have to record those losses on their own books and would record it elsewhere. So in 1992, when the mark-to-market accounting is right at that first dark line there, and that is really when a lot of the growth started to happen within Enron. So then this comes into play when Jeffrey Skilling becomes the new CEO in February of 2001. And apart from the mark-to-market accounting, he was also a big contributor in them trading energy derivatives, or like I said earlier, power. So what they would do is during the California energy crisis, they would create power shortages by calling different power companies and telling them to basically turn off the power. And then Enron was a part of what is called a spot market for power, and they would then be selling power to different people throughout California at a very high price, a part of a deregulated market. And as you can see on the graph there, over time, especially in the early 2001 time and mid 2001, the cost was very high for any sort of power. And right at that bottom of that first spike there is when Jeffrey Skilling came in as the new CEO, and he left as CEO and resigned very unexpectedly after that big drop at the end. So then there's the downfall of Enron. Their stock price died very quickly. This is right around when Bethany McLean published the article, "Is Enron Overpriced?" So the article basically, she was the first person to really ask questions about Enron's practices. How are they making money? Which no one could really tell her because the ways that they were making their huge profits were very unethical. And that article came out in March of 2001, which is right here, which is a first major drop, which made a lot of other people start questioning the practices. And then in the third quarter, so in October of 2001, Enron reported their first major loss of $638 million. So that is that big drop at the end. And because of that loss, the FBI started to investigate into Enron's transactions with Andrew Fastow. And Andrew Fastow, while he was a part of the company, he also owned many of the special purpose entities that Enron was transferring over those assets with losses. And right before, I believe about a week before Enron declared bankruptcy, they tried to sell themselves to Dynegy, who was originally going to go through with it, but eventually backed out, and Enron declared bankruptcy very quickly after. So this is a case of fraudulent financial reporting. So they did not correctly report their financial statements. And in that case, there are many different winners that came out of it. So Andrew Fastow came out with $40 million, Jeffrey Skilling $200 million, Kenneth Lay $300 million, and then many different insiders, so friends of the management as well as different employees, came out with a total of $1 billion. But also 20,000 employees did lose their jobs, including $2 billion in pension funds and $74 billion loss for the shareholders. Now those winners, while they did come out with money, they also had different penalties.
All right, guys. I'm going to go over the penalties that occurred during this time. In total, there were over 20 different people who ended up getting charges throughout this time. I'm going to go over a few of the key players that got convicted. Kenneth Lay was the CEO at one time, and he ended up getting 6 counts for conspiracy fraud for his part in advertising that the company was doing really well, knowing that it wasn't doing well, and in the meantime, he was selling all of his stock. He didn't actually end up going to jail because he died shortly before getting sentenced, so I guess you could say he got off easy. Jeffrey Skilling, he's the guy who came up with the mark-to-market accounting. He ended up with the most amount of counts, conviction rate. He got 19 counts for his part in modifying the financial statements to be favorable. And he ended up spending, he ended up being convicted for 24 years, but he only spent 12 years in prison. He is actually out of prison at this time, and he's back in the energy market. So all these guys were barred from being higher echelon members of public companies, but that ruling doesn't say that they can not participate in private companies. So Jeffrey Skilling's is working with a private company currently. Andrew Festel got one of the shorter sentences. He only got 2 counts for conspiracy and fraud, and his conviction was related to his play in the special purpose entities. He was the key player in creating all the special purpose entities that was hiding all the off-balance sheet liabilities that allowed their financial statements to look so good. So he only spent 5 years of his 6-year sentence in jail. An interesting fact about this particular case is generally when there's a fraud situation in companies, the people who are directly involved with the fraud are the ones who get criminally charged. And this was a special case where people that were not necessarily directly involved with the fraud ended up getting criminally charged as well, as opposed to civilly charged, where they would just be sued to try to get back some of the money. Arthur Anderson ended up getting a felony for shredding documents, and there was a couple of Merrill Lynch upper echelon management who ended up getting criminal charges as well. Next, I'm going to talk about the risk factors involved with this. Think of risk factors as the environment that allowed for the fraud to occur. And we like to talk about this in terms of the fraud triangle because there's typically 3 parts to this. So the first part of the fraud triangle is referred to as the opportunities that allowed them to conduct the fraud. The first opportunity that they had was the mark-to-market accounting. And the mark-to-market accounting really allowed them to make their financial statements look really good so that investors would start pouring money into their company. This is how they raise the price of their stock. The deregulated energy market was a big opportunity for Enron as well. What they were able to do was go into California and kind of create that energy crisis. And so they literally were calling the energy markets and shutting down the energy so that they could increase the price of energy. And through these transactions, they were making lots of money off of it. And another opportunity that they had was the lack of independence from their auditors. Arthur Anderson was their auditors, and we're going to talk about that a little bit more coming up. So the next part of the fraud triangle that I'm going to talk about are the incentives. Probably the biggest incentive that allowed this fraud to occur was that the executives had a high, their bonuses were based off of their performance. So it allowed them to be riskier in their dealings so that they can continue getting their high bonuses. Another incentive that they had was that Enron went around the country telling everyone that they were going to be the #1 country or the #1 company. At the time, they were the 5th largest company in the United States, but they wanted to be #1. But obviously, if you're going to tell everyone you're going to be #1, you should probably act on that. And so they had a lot of incentive to try to be the #1 company, even if that meant overstating some of their balance sheet information. And then, of course, all the upper echelon management owned hundreds of thousands of shares of stock in the company. And the more stock you own, obviously you want the stock to increase in price. So this allowed them to make sure that the stock was continuing to go up so they can continue getting rich. The last risk factor in the fraud triangle are the attitudes. And the attitudes is kind of the rationalization for why they committed the fraud that they were doing. They had a excessive interest in the stock price, seeing as that they owned a large amount of the shares of stock, and they weren't only saying that it was for them. A large amount of their employees had stock in the company as well. So their attitude was that, well, everybody's got stock. It's important for us to continue to get the company to where we want it. And the other part of this is Jeffrey Skilling had high performance standards for his employees. The employees were required to be rated on a scale of 1 to 5. 1 would be considered a good employee, 5 would be considered a bad employee. So they would go through and rate these employees 1 to 5, and if you were on the lower end of that, you would end up getting fired. So the employees were more risky because they wanted to maintain their jobs. Next, I'm going to talk about the audit failures. So the auditors had a responsibility to the company to make sure that they were auditing the financials correctly. So this next slide is talking about what the auditors could have done to maybe find some of this fraud. Auditors have a number of tools in their pocket to be able to identify some red flags in financial statements. And when they identify red flags, they look into it further, so maybe they can identify some of the fraud going on. One of the analysis that they could have done is something referred to as cross-sectional analysis. And cross-sectional analysis is taking the company like Enron and comparing their financial statements to other companies within the same industry's financial statements to see how they're comparing to. So the first graph up here shows Enron's revenues compared to other companies within their sector. That's referred to as cross-sectional analysis. And as you can see, Enron was reporting revenues much higher than everyone else. Something else they could have done to analyze the situation is referred to as horizontal analysis. Horizontal analysis is taking financial information from the same company, so Enron's financial statements from year to year, and comparing it against each other. So down here I have an excerpt from their financial statements from 1999 to 2000, and there is a 50% increase in revenues over the course of 1 year, which is virtually unheard of. So that's some of the analysis that they could have done. But probably the biggest issue that the auditors were having here was that they didn't have independence from the company that they were auditing. And what independence is an auditor is required to not have a high financial stake in a company so that they can do their job without, they shouldn't want the company to do well. It should be about making sure the financial statements are accurate. And in this situation, Arthur Andersen was getting over $50 million a year in fees from Enron, and those fees were not just from auditing fees, they were for consulting fees as well. So they had a high interest in the company continuing on, which breaks their independent practices. So there's a few things that we learned from this case. One of the bigger things is that it was not the auditors who uncovered this fraud. It was not the government who uncovered the fraud. It was actually people like Bethany McLean. It was stock analysts who started going in at Enron and looking at their financials and asking, this doesn't make sense. And everyone else started looking at it when they started asking these simple questions of how are you actually making money? And so it's important that we, in life, if something doesn't seem right, we should speak up. And another important lesson from this situation is that sometimes deregulation is not necessarily a good thing. Typically, deregulation for business is a positive thing, but sometimes it leaves the door open for companies like Enron to take advantage of this. So there is a fine line between deregulation and what the government should come in and try to prevent. So just to go over everything that happened, Enron was the 5th largest company at one point. Due to their shady business practices, it only took them a few months after it was uncovered to go bankrupt. And Arthur Andersen was in the same boat. Due to their shady practices and not doing their job, they also went bankrupt within 3 to 4 months. And some of the biggest losers in this situation were actually the employees. What we saw was that thousands of employees ended up losing their jobs, and they didn't just lose their jobs, they also lost their pensions because they all had an enormous amount of stock in Enron companies. So when Enron stock went down to nothing, they also lost their pension plans, so they were broke. And so the most important thing that came out of this bad situation was the Sarbanes-Oxley Act of 2002. And this was a piece of legislation that that tightened up some of these practices that allowed this fraud to occur. So a couple of things that the Sarbanes-Oxley Act does is that it requires that the upper echelon management sign off on their financial statements when they report them to the SEC. And so this makes it so that guys like Jeffrey Skilling, who was testifying before Congress that he had no idea that his financial statements were not accurate, they're no longer allowed to claim ignorance to their financial statements. And another important aspect of the Sarbanes-Oxley Act was that it made better regulation for the independence of auditors. So it made it so that when an auditor is dealing with public companies, they're only allowed to do so many services, and that way they can keep their independence and do their job accurately. All right, at this time, we'll take any questions you guys have. President Vicky?
Great job, gentlemen. A couple of questions for you. First of all,
Dr. McGee.
great job, gentlemen. A couple of questions for you. First, Enron is an important client, but one of only many for Arthur Andersen. So what led to Arthur Andersen's bankruptcy separate from Enron's under those conditions? And secondly, I mean, even at this deregulated era in which Enron was operating, why wasn't it required for a Fortune 50, Fortune 100 company to have to switch auditors periodically? That's considered a best practice today, and yet they got to work with a single auditor for over 15 years, clearly not to the benefit of the public. So if you want to take on those couple of questions, that'd be great.
First one, second one. Okay. Can you give me the first one again, President McGee? Sorry.
Arthur Andersen was only had Enron as one of its many clients. How did Enron alone take down Arthur Andersen and drive it to bankruptcy?
Oh, so Arthur Andersen was found to, they ended up getting a criminal charge for trying to hide the fraud. So they were shredding the documents that they had for Enron's company, and when they got investigated, they ended up getting the felony charge. And after they got the felony charge, nobody wanted to work with them. So it's not that they couldn't necessarily continue working; it's that nobody wanted to work with them because they got in trouble. And their independence was actually, so nobody would trust what they were doing anyways.
As for your second question about why Enron was able to keep Arthur Andersen as their auditor for so long. At the time, Arthur Andersen was known as they were the world's largest auditing firm. So they were seen as the most trusted auditing firm as well. So if you're being audited by such a trusted company, why would you need to change is kind of how many people would see it.
So mark-to-market accounting, when is that beneficial to an organization?
Well, in their situation, it was beneficial because it typically wouldn't be beneficial, but they were able to continue the fraud because they took when they were having losses and they were hide them in these special purpose entities. So typically it would only be beneficial to the extent that they were actually having revenues, but they were taking their losses and hiding them. So typically to the extent that they actually had those revenues.
Thank you.
You mentioned, Rodney, that the Merrill Lynch employees were criminally charged. I was just wondering what their involvement was. If you could talk more about that.
The Merrill Lynch employees actually knew what was going on, so they came in and they actually had people questioning like Enron's dealings, and they were looking at their financial statements. But because they were doing so well, they wanted to climb up the ladder with them. So they knew exactly what was going on, but turned a blind eye to it. And they had like recordings of them acknowledging the fact that what they were doing was maybe not so right. And that's how they ended up getting busted. Dr. Eidson? Sorry, I didn't mention that.
Yeah, you indicated that they individually made a lot of money off of this. Can you kind of explain again how they made their money off of owning or being part of Enron?
Yeah, so there's two main ways that they made their money. One being their bonuses that they would receive from the company for high performance of the company. So within the mark-to-market and the deregulated energy market, the company was flourishing and gaining so many profits. So the company then would give out bonuses to these executives, as well as with owning a high amount of shares in the company. When it was going up, they would sell some of their shares to make a gain on that.
Yeah. Are they poor? No, I don't think so. I think, yeah, they were, they didn't get back all the money that they were able to sell off, I don't think. Yeah. Yes, they do. Yeah, Jeffrey Skilling's doing quite well, I think.
In a sense, yes, because they did serve jail time, but also in a sense of they still are doing quite well financially, no. So.
Well, they haven't committed any fraud since then. I think what was more important wasn't. Good question. I would say probably what was more important than what happened to those guys was the piece of legislation that came about from it, the Sarbanes-Oxley Act. That does a lot of preventing that kind of activity from occurring. So if they are committing fraud, they're doing it in a much sharper way now.
Thank you, Rodney and Nathan. We'll take a short break and we will be back at 3 o'clock. So you have about 3 minutes. Thanks.